Good morning, everybody. Welcome to the game plan. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. And of course, what we're going to do today is get into the nitty-gritty, the charts, the data, the levels, the trading opportunities that are out there for the trading day. Again, no hype, no nonsense. These are the trades, probability levels, etc. All right, so let's get right into the S&P 500 here. If we take a look at the S&P pre-market, we are certainly trading higher. And you can see, again, this was 4 in the morning. Now, yesterday, the futures were open, the S&P futures were open, but the stock market was not. So again, a lot of this is reflected in yesterday's price action in the futures, but ultimately this morning on the SPY, the tracking ETF for the S&P, we are trending higher. Now notice this trend line right down here. I want to flip over to that now. This is this trend line right here. So we are currently above it. Now, if you remember on Friday last week in the game plan, we talked about, would the S&P confirm a breakout of this key double top, triple top on Friday? And the answer ultimately turned out to be no. While we were above it during the trading day, by the end of the day, the markets had sold off and we closed back below the high of the previous day's high on Thursday, right? So ultimately, there was no confirming factor to say, okay, a breakout is in store. However, we can still confirm today. So what I'll be watching very closely today is, does today's close on the S&P close above Thursday's high? If that happens, that would confirm a breakout. And let me explain what that means. It essentially means probability flips now to a downside bias to a near-term upside bias with a potential to go up to this longer trend line that stretches out here, which is around 630 on the SPY. So this is the SPY. Again, that's what we're looking at. That's the tracking ETF for the S&P. If you want to equate that to the S&P, that would be around 6,300. Okay, so again, today is a very interesting day to watch and see how things go. Do we see another day like Friday where the markets initially were above that level, but by the end of the day, the institutions push it back down? Or do we see that confirming factor that now flips probability to further upside? Now, listen, in all fairness, remember, just because probability flips to the upside doesn't mean that that's the angle that's going to ultimately end up playing out. There's always a percentage chance that it comes and rolls over. But my job as a technical trader is to follow the probabilities. If I look to trade, let's say, only trading opportunities that average a 75 to 80% success rate, I can quantify that I should make X amount of money and X amount of winners over the course of time. All right. So we'll keep an eye on that. Let's flip back over here to the main computer and we'll take a look at the QQQ. The Nasdaq 100 on the charts here, what we can see is it's trading right into this double top or just above. So this wouldn't be able to confirm a breakout today above its double top, but I certainly will be watching to see, do we close above it, which would then potentially allow for confirmation tomorrow. Now, if we bring this chart down, if it does confirm, the upside would take us to about 554 on the QQQ Nasdaq 100 tracking ETF. All right, flipping over to the 10-year yield. The 10-year yield today is bouncing a little bit. Last week was a wild week. Look at how we had broken below. Then they faked everyone out as we closed back above. Then they brought us right back in. To me, this is still a bearish setup that I would expect price on the 10-year yield to start heading down towards the 4.15 level. Now, in the short term, that's going to be a bullish factor, right? So again, we have to remember that short-term yields going down is bullish because the market looks and says, okay, well, the U.S. economy is still pretty strong, so lowering in yields is a stimulus factor. What we don't want to see happen, or at least the stock market doesn't want to happen, is where yields are dropping because we're seeing the jobless rate skyrocket. Right? So if yields are coming down because the U.S. economy is crashing, that would be then a very big negative for the U.S. stock market because it would affect profits, right? How much consumers can spend. All right, looking at the DXY real quick, the dollar chart here, we know we had that head and shoulders pattern right here that broke down, closed below, confirmed. You might get a retrace to the scene of the crime, but ultimately this breakdown can now be measured in terms of a downside target for those of you that follow the U.S. dollar. We take that line from the high of the head to the trend line that marks the neckline of the head and shoulders, and then we pull that line to the break point right there, and you measure it down, and it basically takes us to 104. So whether that's in a week or a month or in 3 months, ultimately your target on this pattern break is going to be 104 on the DXY. All right, let's look at some earnings numbers this morning. Baidu reporting earnings. Now, again, this stock had rallied sizably to the upside on the daily chart. It is pulling back a little bit on earnings. You can see the pre-market data right here. There's no trading levels for me. I might be interested on a swing basis of rebuying somewhere in the 86 range here, maybe down to about 82. But suffice it to say that I do think that China is on the mend. Their economy is on the mend. Relations, honestly, seem a little bit better under Trump right now, and I think that is all a positive for Baidu and the Chinese stocks. Here's Medtronic. So Medtronic, they make devices, by the way, for diabetes and for heart issues and so forth. And we know that with the weight loss drugs, things have kind of gotten a little crazy, a little less demand for those, and probably will continue to be a little less. So if we go back to the Medtronic chart, you can see it is down on earnings. They beat on earnings, but they missed on revenue. So the stock is trading down. The only level I'll be monitoring today, if we take this low from 2023 and we connect it right through here, this level would be around 80.75 to 80.5. And that, if we fall all the way into that, I would probably be looking to play it as a day trade for a bounce off that level. Again, should be a major technical support there on the chart. Now let's flip over to Nvidia and take a look. So Nvidia, again, has continued to rally. In fact, let's go over to the big board and check this out here, folks. So if we take a look at the big board, we can see that Nvidia is trading up a little bit on the day, a couple dollars from Friday's close. It's at 141.65. On a day trading basis for me today, and this is even on a swing trading basis, what you want to be following very closely is this gap fill right here. So this right here, you can see from this close, remember, if we all remember, I was actually in North Carolina, and I was still doing the game plan from the hotel room at that point, but this is the Friday into Monday where Nvidia fell 17%. So what's amazing here is that price is now regained and is now trading back to that level. Now, on a psychological basis, there were a lot of investors that bought in here that then got like their head handed to them. I mean, it was just atrocious. What a drop. I mean, who expected Nvidia to drop 17.7%? I did not, even myself, right? Even though I think it's ridiculously overdone, I think it's going to eventually fall a lot more. In one day, 17%, I didn't even think that. The point being, from a psychological aspect, the reason gap fills work as resistance points is because all of these people freaked out, but they didn't want to take the loss. Now they're getting a chance to get out at break even, and they're going to say, whew, thank goodness, you know, that was a scary one, but I got out, I'm done with it, I don't even want to mess with it, etc. And a lot of that will be selling here. And so that ultimately should be good resistance. The level's right around 142 or a pierce of 142. I will be eyeing that today as a day trade. It could also work as a swing trade. In all fairness, we should see some sort of rally up here, which we're basically at, and then it should be at least a trickle down in the short term back to the downside. All right, so again, keep an eye on that level around 142 on Nvidia. Let's go back to the charts. We have one more here on SMCI, which is trading at 51.33. The remarkable aspect of SMCI here is that it is now up 100% just from the lows on February 3rd. This was $25 right here. It's now at $51 and change. Now, there is a level coming up I'm going to be eyeing today for maybe a quick trade, about $52 on this. And then really the big level is going to come up here. You have a gap fill here and a gap fill here. They're both small gap fills, but it still should be some significant resistance on the chart, and that's between $55 and essentially $56 on SMCI. So quick trade maybe around 52 today, but then we're looking at more of a sustainable pullback on this around 55 to 56. All right. Let's get to Bitcoin real quick here. I'll go over to the big board. We'll talk a little bit about Bitcoin and the price action. The first thing to know about crypto is that it has gone to sleep. Now, you might say, well, why has it gone to sleep? I mean, here we have a stock market that's still at all-time highs. Bitcoin's not at all-time highs, but it's pretty darn close. But the kicker is this. There was so much hype from November when Trump was elected because he's favorable towards crypto and he put the right people in place in the SEC, et cetera, and even into his inauguration, that there was a lot of energy expenditure. There was a lot of hype. And what we know is when we go to a big party and we party hard, like the crypto players did is that you tend to have what we call the hangover or the drawdown or the kind of you need to sleep it off kind of effect, right? So I think that's what's going on here is that there's just no new catalyst that's exciting in the crypto community at this point. And so you have crypto, or specifically Bitcoin, but the altcoins have really fallen too, has now gone into what we would call a sleeper phase. Now the sleeper phase is okay because ultimately at some point it's building up energy that when it wakes up, it's going to have a big move. So the question is that big move a massive pop up, breaking the 108, 109 level here of resistance, going to this upsloping trend line, which is around 115, maybe even 120, or are we going to have a breakdown, in which case you get the bigger move down to 74, 75,000. So again, it's a sleeper phase. It kind of makes crypto honestly a little boring right now for those of us that have followed it. I mean, it's very, very rare it has these type of periods. But again, I wanted to explain why this period is occurring because of this sleeper phase. After so much excitement for a couple months, it's now kind of like, okay, let's take a breather here. It's what we would call the hangover effect from all that craziness. You see that a lot of times after holidays. People, especially like Super Bowl Sunday night, the Monday after Super Bowl is oftentimes very quiet because people had a lot of drinks, they ate a lot of food. It's just a slower environment for the markets. All right. So let's get into a couple other things here. I do want to talk a little bit about gold. And gold here, folks, we can see very clearly, right? Gold is pushing back up, but the doji from last week is still intact. So remember, we talked about this last week. This is a doji. It's not a topping tail. Topping tails are bigger bearish signals than dojis. However, a doji is still a bearish signal. It's just not as powerful. As of now, look at the high of the doji. We crept up the couple days after and then had a big sell. Now we're creeping up again. As long as we don't close above that doji, the bias based on data and probability remains to the downside on gold. If we have a daily close above 29.45, let's say this high right here, then you would say, okay, now it's in a bullish phase again with upside to this uptrend right here, which is right around 3,000. So again, if we zoom out, you can see again where that comes from. There are two parallel lines that really has kept gold in check. The lows here were in February 2024. So 1 year ago, we've been in this parallel channel. This would be resistance. But again, as long as the doji holds, the probabilities, and I'm strictly speaking data driven here, would be for a pullback here. Again, if we close above, then you're headed here, and then that would be a major, I repeat, major resistance level. Silver, let's take a look at silver real quick. Silver is upticking a little. Nasty day on Friday there, and again, it's just the nature of the beast. When you have this big of a pop and you reverse and close negative, that just does a lot of technical damage to people that bought in this run up here on gold, on silver. It doesn't mean it can't be eclipsed, but it certainly puts a little bit more trouble in the chart of silver. This still is a bullish pattern, but now with a caveat here of negativity right there. So again, right now it's creeping up. At this point, I'm in neutral on silver. I was bullish here because it was a bullish flag pattern. Now with this candle here, it's now more of a neutral where it could go up, it could go down. I won't pass judgment on it at this point in time. Taking a look at oil today, let's take a look at where oil trading. So oil's continuing to trade. Remember, I got out of my short right down here. Since then, it hasn't done much. It's just been a lot of chop. Obviously, we have negotiations with Russia and Ukraine to try to finalize a deal there. We'll see if that happens. If that does and we open up the allowance for Russia to sell a lot of oil, it could bring oil prices down. Also, any sort of weakness in economic data in the U.S. would also trigger an additional sell-off. Any pop on oil, I would look to start to re-short probably around 77. Right in here as a Fibonacci level, you have all these little lows from this final pop right here. That would be my level to watch. And then lastly, natural gas. There's your parallel here. I'll in fact run over to the big board to just talk a little bit about this. So this is a chart again on natural gas. We can see here's your parallel, here's your breakdown, here's your confirming candle of a breakdown, here's your retrace to the scene of the crime. This is major, major resistance. And yes, I did go short a little on natural gas right into this level here. And look, I'll be looking for a drawdown in price. All right. So again, just using the data. And by the way, let's be fair and clear, just because I did a little short here, it doesn't mean it's going to work out, right? There's always a chance based on probability that it doesn't do what I think it's going to do. But I, again, am looking at the patterns and making decisions based on historic sequences, right? So remember, if you looked at 100 or 1,000 of these patterns, about 80% of them would go down to the downside. Still leaves 20% that don't and push up. We know that can happen. But I always like to make that clear because it just shows you that there's no perfect recipe. Like if you ever find a trader that doesn't have a loss or doesn't have a decent, a 20% losses or whatever it is, it tells you that they either have insider information or they're BSing you, right? So those are the two ways that traders or investors or insiders can have no losses, is if they have insider information or they're just fibbing, right? So ultimately, you have to understand is that this favors this. It doesn't guarantee it. And again, it's about when I see trades and I'm taking trades, it's about taking all the trades that I can see that match that criteria, knowing that 80% or 75% of them will work out, but still 20 to 25 won't. But the idea is that this group of 75% to 80% will be higher in profits than the losses from the 20 to 25. And it should be, right? It should be, even if the losses are a little bit bigger, it still should, the math still should work out very nicely. All right, let's jump back here, guys, as again, coming to the end of this game plan. As always, folks, love being back in the studio. Love being able to show you on the big board there what's going on. We appreciate all the kind words. Thanks for attending the Get Smart big event yesterday that we did. And as always, folks, our goal here at Verified Investing is to make sure that we are teaching, educating, and giving insightful data-driven analysis. Not this nonsense hype you can find on X or wherever else the social media players are pumping things, or the mainstream media, which will bring on analysts that have a bias from their firm that's saying, oh, we'll talk up this stock or that. Nonsense. Let's focus on the data. That's what the big institutions, the big hedge funds are doing, and that's why they're making billions of dollars. Granted, they had billions to start with. We all start with a lot lower amounts, but we can still grow our nest egg very nicely using data-driven analysis. Thank you so much for tuning in, guys. I'll see you later. Take care.